We have our last two sessions of the event, and our first speaker is Lucas White. Jeremy Grantham from GMO, unfortunately, is unwell and unable to join us this morning, so we had to make a literally last-second change. Lucas is a portfolio manager working with Jeremy on GMO's focused equity team. He's been involved in setting up their climate fund, which he will talk to you about. And frankly, I really appreciate the fact Lucas has stepped in literally at the last minute. So please join me in welcoming him. Thank you.
Yeah, unfortunately, Jeremy couldn't. Let me turn this on, I guess. Jeremy couldn't make it. He's sick. He's disappointed. For those of you who aren't familiar with him, he's an incredibly passionate advocate for climate change mitigation efforts. He has an institute that he's sponsored, the Grantham Institute for Climate Change and the Environment. He also has a foundation which is dedicated to environmental issues, and in particular, climate change. So he was excited to come down here. I'm a somewhat poor replacement, but I'm something, so hopefully I'm better than nothing. It's a little tough to come up here at the end of the day because some of my fellow presenters who have done a great job have already covered some of the things that I would have talked about, so I'll try to breeze through those. But interestingly, there are some things which I might have thought would be shown at least in one way, shape, or form that haven't. And I'll start off with some climate slides, which is a little embarrassing to present climate slides to climate scientists who certainly know a lot more than me, but and maybe a little obnoxious for an investment guy to do that, but I'll do it anyway. So here we're looking at the global population. Really all I'm trying to get at, and I'll breeze through these, is just how dramatic things are, and also the acceleration feature that a couple people have mentioned earlier. So here we're looking at the population. Obviously, it'd be more surprising if we weren't doing something to dramatically impact the environment than that we are. And here we see carbon dioxide concentrations in the atmosphere. Going back 800,000 years, we've never seen levels like this. What gets talked about quite a bit less are methane concentrations, and methane is dramatically worse in some ways for the environment or for global warming than carbon dioxide, but it's a smaller percentage of greenhouse gas emissions. But this is going back 800,000 years as well. And here we see temperatures rising, which is no big surprise to anyone in this room, but going back to 1880, and you see that it's moving in line with carbon dioxide concentrations, but also, once again, that these things are accelerating, which isn't talked about quite as much. And I'll try to channel my inner Jeremy a little bit. I work with him quite closely. He has some colorful language to describe the climate scientist, which I am now forced to convey to you, but he will use colorful language like chicken shit and things of that nature to describe their reluctance to point out just how scary this stuff is and how dramatic it is. And the acceleration doesn't get anywhere near as much coverage as you might think. And there are recent studies which have come out looking at ocean temperatures showing the same thing, that ocean temperatures have been rising at almost 3 times the pace in the last 20, 30 years versus the previous 50 years before that. And here we see ocean levels rising. And once again, you see acceleration here. I should actually draw a trend to this. But in the first 50 years of this, ocean levels rose a couple inches. In the last 50 years, they've risen 6 inches. So 3 times as fast. Once again, this stuff is pretty scary. The projections going forward, I know earlier Peter mentioned 2 feet being a reasonable projection. Lots of other people are working on these problems, have come up with projections 3 to 6 feet. One interesting point, I think, is it better to be accurate and give your best guess, or be cautious? The risks are so high here. We can't afford to be wrong. And I think Jeremy's take is that we should be more alarming, sounding the alarm bell and be conservative and say what's the worst case scenario. You risk maybe a little bit of credibility with some people, but it would certainly be better to be cautious and careful in this situation than underestimate what actually happens. And we've seen the impacts of climate change in all sorts of ways, whether you're looking at droughts, floods, natural disasters more generally, major downpours. Downpours have a huge effect on agricultural productivity, as there's lots of soil erosion. All the soil erosion basically comes from the big downpours. We've seen increased incidences of that as well. But there is another take. This was in the New York Times a couple months ago, and I was pretty sure this wouldn't have been presented already. Samsung Chemical Coating Company came out with a full-page ad where they say there's no relationship between the amount of carbon dioxide emission and global warming. The current global warming is caused by the synergy effect of increase of the Earth's precession due to sea level rise. So I'd like some of the scientists here to explain to me how they missed that. They predicted an ice age that's going to start in 2060. It'll last about 200 years, and the creatures living in the sky, the land, the sea, will become mass extinctions. Large tsunamis and earthquakes will make dead creatures like coal and oil as in the past. At this time, the creatures that were exposed to solar radiation at the time of the ice age would become mutations and begin the birth of a new species. So that doesn't sound good. And perhaps most terrifying of all, me to Scott Pruitt of the EPA and say the future of mankind depends on you and President Trump. So that doesn't sound good. So getting to what is more my area of expertise rather than yours is kind of how we've dealt with it in our investment strategies. On my team, the focused equity team, our biggest strategies are quality strategy. We're investing in big mega cap blue chip companies that have some sustainable competitive advantage. So these are companies like Procter & Gamble, Coke, Google, Microsoft, et cetera. And as we've kind of run that strategy, we've worried about climate change and ESG risks. Back in 2009, we had about 13% of the portfolio in integrated oil and gas companies, and we've actually sold all of that. And that wasn't a divestment thing. That wasn't a moral or ethical thing. That was a risk of stranded assets concern, that these companies wouldn't be able to produce all of their reserves, and there was significant risk for a long-term buy and hold strategy like our quality strategy. Those weren't risks that we were comfortable with. And you can kind of see on some various ESG or environmental metrics at least, greenhouse gas emissions, energy consumption, water usage, our strategy screens much better than broad equity benchmarks like the S&P 500 and MSCI World. The interesting thing about this chart is that we're not trying to do this. This is just an output of kind of a investment process where you're considering all of the risks, and it's just kind of a fallout, not something we target. I guess I didn't introduce myself at the beginning and explain, I guess I was mentioned as a portfolio manager, but there are two strategies that I'm the lead portfolio manager of. The first one is the resources strategy, where obviously you have to think about what you're going to do with oil and gas. It's kind of hard to imagine a natural resources strategy that isn't invested in oil and gas. But back in 2011, when we launched the strategy, largely because we were focused on the idea of growing demand, in particular from the industrialization, urbanization, and development of emerging markets, this growing demand meeting up against finite supplies of cheap, easy to get at, easy to process natural resources. So as we looked at launching that strategy, what was the biggest risk? There are all sorts of risks. Natural resources are a very risky place to invest and very interesting place to invest as well. But the biggest long-term risk that I saw, and the only one I really saw, was that you ended up with these stranded assets that we've already referred to. So what did we do? Well, from the beginning of the strategy, we've always excluded coal and tar sands companies that are particularly, or involved in products that are particularly bad from a carbon emissions perspective. We've excluded particularly poor ESG offenders. We have a much lower percentage in energy than any sort of cap-weighted approach to natural resources. So a cap-weighted approach would be about 70% energy. We're closer to 40%. And within that energy exposure, we've always targeted some alternative energy companies. And what's happened over this time period since 2000, well, this goes back a little bit further, but over the last few years, the prices, here the unsubsidized, levelized cost of energy or electricity from solar and wind over the last few years, the costs have dropped dramatically. And we see the same thing, this was referenced earlier, but here's the actual data for lithium-ion battery prices. Storage costs have been dropping dramatically, although once again, this isn't for really utility scale energy storage, but for electric vehicles or whatnot. And as those costs have dropped, they're becoming more and more competitive with traditional forms of generation. We're not quite there yet, as was referenced in the last talk. There are tremendous costs associated with integrating intermittent renewable sources of energy into our electric grids, which are these archaic kind of creatures which were built for just one-way generation, transmission and distribution, and storage is an obvious cost as well. But you can see the light at the end of the tunnel as the costs continue to fall for these technologies. they're going to be more and more competitive, and there's going to be more and more of an economic incentive to pursue them beyond the concerns about climate change. And I think that's really important, because everyone in this room is probably pretty convinced that climate change is an issue that we should act on, and I think we could probably agree that we'd be willing to pay a lot more money to avert the kind of potential damages from climate change. But for the rest of the world who's not quite as excited about that, it's really important that the economics be meaningful and that they make sense. And as we've been doing investments in alternative energy over the last few years in our resources strategy, we've seen more and more opportunities as time has gone on, as these companies have much better business models, obviously, when they're kind of profitable and able to compete than when they were 3, 5 times, 10 times as much as the competition. So just last month, actually, we launched a climate change strategy, which is kind of purely dedicated to the opportunities. Most of what we've been talking about is investment implications to this point are talking about the risks associated with climate change, carbon pricing risk, stranded assets, things like that. But there are also opportunities as well. And when we think about opportunities, we're really breaking them out into 2 groups. There are companies involved in climate change mitigation, so that's obviously alternative energy companies, solar, wind, hydro, nuclear, whatnot, batteries and storage, anything that reduces our energy impact on the world, so energy efficiency efforts, electric vehicles, electric grid companies, smart grid companies working on smart grid technologies for integrating intermittent distributed renewables are certainly at play as well. And then importantly, technology and materials, which are interesting ways of kind of investing as well when you look at lithium and copper and think about whether those are good ways of investing in this sector. And then there are companies involved in adaptation and climate change. We talked a bit earlier, there were some great slides and great stuff about research about agricultural productivity. A study just came out a few weeks ago in the from the National Academy of Sciences, which published it. They didn't actually do the study, but they published the study. And it talks about agricultural productivity dropping as a result of climate change on our current path by 2050 to levels not seen since before 1980. That is a disaster scenario. If we add 2 billion people to this planet, which is what we're talking about adding right now by the UN population projections or whatnot, and you take agricultural productivity and you drop it from current levels down to pre-1980 levels, I don't know how you're going to feed the world, quite frankly. You're going to have a lot of trouble. So any companies involved in maintaining agricultural productivity to the extent that we can, whether that's drought-resistant seeds, fertilizer companies, machinery companies, irrigation companies. There are some agricultural plays. Mostly we're looking at the public equity markets for how we're approaching it, because we don't want to compete with KKR. But there are opportunities in agriculture. Water treatment, processing, recycling, efficient use of water, figuring out how to minimize your water impact as water becomes a more valuable resource. Those are certainly companies that we look at as well. Energy efficient air conditioning, insurance, reinsurance. I learned today that reinsurance is a very friendly, cozy business. I wasn't aware of that before, but and a tremendous amount of investment is going to go into this effort. You're talking about $9 trillion to decarbonize electricity, $6.5 trillion towards energy efficiency efforts, another $4 or $5 trillion going into overhauling our electric grids. That's a massive amount of investment. And frankly, we need a massive amount of investment because despite all the talk about alternative energy, all the talk and hype behind solar, wind, and whatnot, it's still a tiny fraction of the overall energy puzzle. And every year we continue to consume more and more fossil fuels and emit more and more carbon dioxide. The good news is that the projections going into the future are for very strong growth in renewables. And interestingly and importantly, I think, the projections continue to rise over time. So the projections in 2017 are significantly higher than last year's projections, which were higher than the previous year's projections. People are continually underestimating the amount of investment, the amount of work that needs to go into fighting climate change. And our very strong opinion and belief is that these current projections are likely to dramatically understate the actual investment that will go into these technologies and solutions. This is just looking at another example of the secular growth that we would expect to see. We're looking at electric vehicle sales going out into the future, and you're talking about very healthy growth rates. And once again, we're at the very beginning stages of this kind of a transition. You can't even see that little sliver representing electric vehicle sales as a percentage of overall vehicle sales. And this doesn't even include the industrial vehicles and 18-wheel trucks and all that stuff. So there's a long way to go, and people are worried about Trump. What's the impact of Trump's policies and his beliefs? Obviously, he's come out and said he thinks climate change is a hoax orchestrated by the Chinese. But he's also very focused on jobs. He's a pragmatic businessman. He's really focused on jobs. And guess where jobs are coming from? They're coming from solar. They're coming from wind. Job growth in the renewable industry has been 8 times that of the broader economy. The important thing is that he doesn't remove the federal incentives and tax credits and everything that's incentivizing solar and wind development. At this point, he has said, although he tends to change his mind, he said that he's okay with the current incentive programs, and that's really important. I think that it's also important to understand that U.S. federal policy for the next 3 years and 263 days or whatever are left is only one piece of the puzzle. This is a massive, multi-decade global effort. And it's also not just a federal effort. There are state targets for dramatic emissions reductions. There are city-level initiatives with the Global Covenant of Mayors, which is a global network of cities that are dramatically or targeting dramatic emissions reductions. India, China, et cetera, are all pretty dramatically driving this forward. This is a global effort and a long-term effort, so I'm not overly concerned. I think this is a freight train that's moving, and maybe Trump can kind of slow it down by a mile per hour in the short run, but in the long term, I really don't think he can do much to derail it, although he may give it a shot. Here we're looking at a question that gets asked a lot when you're talking about impact investing, ESG investing. Do you have to sacrifice returns for investing in companies that are doing good for the world? There's really no good way of studying this long term that I'm aware of. HSBC did have a climate change index. It unfortunately discontinued in March of last year as part of their broader efforts to discontinue their index lines. But over a 12-year period, although with a very different path, they gave equity-like returns. These are alternative energy companies, battery and storage companies, energy efficiency efforts, electric vehicles. You got equity-like returns from these companies. And that's important. We wouldn't be excited about investing in this sector if we thought you were going to have to sacrifice returns. We would be interested in it from a global and world perspective, but from an investment perspective, we wouldn't launch a strategy if we thought we were going to have to sacrifice returns. And it wouldn't surprise me at all if the climate change sector, as we've defined it, outperformed the broad market over the next couple decades. But certainly, we would expect at least equity-like returns from that sector. The valuations don't reflect the secular growth that we were talking about. So when there was secular growth in the tech bubble, you were paying 50, 60, 70 times earnings, 100 times earnings to get access to that secular growth. Now, you get these companies at market multiples. This is the MSCI Global Environment Index. We have a universe of companies we look at, tells much the same story. You can take the HSBC climate change constituents and propagate them forward to today, much the same story. So you're not paying a huge premium to get access to this secular growth. And why might that be? That doesn't make sense. The world's not that easy. It's not that simple. Well, here we're looking at, unfortunately, the axis somehow got chopped off. But you can tell it's down at least. The green line is down. And it's actually down about 90% since the inception of the solar ETF back in 2008, even with solar consumption rising dramatically. So just because there's secular growth, where we can be almost sure there's going to be secular growth, it's in the top line, the sales, the revenues of these companies. We're much less certain whether they'll be able to convert that kind of secular growth into profitability, into cash flows and earnings. And that's really what we're trying to do, what we view our job in running a climate change fund is how do we find companies that are involved in helping the world manage this really dramatic issue that we're faced with, this dramatic challenge, but do it in a profitable way where they're able to make money off of that. And here we're looking at wind, and it's over a bit longer period of time. If we had started this in 2008, it would have told a slightly different story. But over a longer period of time, you have gotten solid returns from investing in wind turbine manufacturers. Importantly, if you invested when they were trading at P's of 100, a price to book of 8, you didn't get great returns. If you invested when they were trading at PEs of 6, you've gotten incredibly good returns for the last few years. So we think it's important to pay attention to value. GMO is a value-oriented shop. We think of ourselves as a value shop, and almost everything we do looks or at least thinks about value. We're going to take a value-based orientation when we look at this sector, because we don't want to lose 90% of our capital investing in passive solar exposure. This is just a bit, that's kind of an anecdotal slide. Obviously, this is a bit more methodological, just looking at the performance of a couple different value strategies within the MSCI Global Environment Index relative to the MSCI Global Environment Index. So value strategies had added value and alpha over the last few years. And we think that that makes sense. It's kind of inherently a sector that's likely to be relatively inefficient. First of all, it's a small mid-cap universe. You're talking about relatively small companies. The biggest solar companies in the world are $2 or $3 billion in market cap. The biggest oil companies in the world are $2 or $3 trillion. They're not publicly traded, but the national oil companies, if they were, would be trillions of dollars in market cap. So it's a totally different world. And in this small kind of mid-cap world of companies that are generally poorly understood, with lots of disruption risk, poorly understood newer technologies, there's a lot of uncertainty. And value managers are unlikely to get really excited about investing in this space. Generally, secular growth stories aren't where value managers play, but they're certainly not going to get the kinds of margin of safety that they generally look for. And where value managers are averse to investing, it's also the case in the resources sector, which I am quite familiar with, you end up with value strategies doing significantly better than kind of broader mandates. And to wrap up, climate change, I think, is obviously a major issue for the world, but it's also increasingly being recognized as a significant investment issue, whether you're talking about the risks or, at least from our perspective, starting to think about the opportunities and how you might be able to make money off of kind of helping the world. Obviously, we're not totally absent of interest in making money and doing this. Once again, we want to invest in companies that make money, but it is nice to help the world as well. Economics are going to be a big factor in transitioning to a clean energy world, and we think that there are going to be tremendous investment opportunities. If you can pick the winners, if you can find the companies that are well valued, there are going to be incredible investment opportunities in this sector, and we think it's a pretty exciting place to invest.
Vivek, a couple questions.
Hi, thanks for that. So this is a question either for you or for Jeff Heel, not sure who. So the topic is nuclear power. We read in the press that nuclear is necessary for carbon-free baseload power. There's a lot of hand-wringing over the fact that Westinghouse is bankrupt and the U.S. government is not providing enough subsidy for the industry. And yet one of your slides shows that even with storage, wind and solar are now cheaper than nuclear. So I don't know if that's true or not, but if it is true, why is nuclear necessary, and is it necessary?
Well, it's necessary because, well, I don't know if it's necessary. It's plausible that it's necessary. There are a lot of people, and Jeff might have more knowledge in this space than me, but there are a lot of people who think nuclear is a huge piece of what we should be doing until we get to a transition point where we have economic solar and wind with storage. The problem is when you see solar and wind costs, like I put up earlier, in isolation, it doesn't take into account storage. I had some bars for storage, but those bars are really talking about overnight storage, not seasonal storage or storage that will get you from point A to point B where you really need it. Overnight storage is fine, but what we really need is longer term storage. Yeah, and solar and wind are seasonal as well, obviously. We're also, one of the discouraging things about the way that we're approaching, this is a little bit of an aside, but one of the disturbing things about the way we're approaching solar and wind and moving to clean energy is we're kind of, there's just no coordination, there's no kind of, nothing makes sense about the way we're approaching it as a world. Like if you really are worried about climate change, guess what? You don't go add more solar and wind in California, right, where it's already relatively clean. You invest that same dollar of capital in India, you invest it in China, you get rid of their coal plants. If you're building solar and wind, why do you build solar equally in Massachusetts, New York, Canada, et cetera? Why aren't you building it in New Mexico? Why aren't you building it in Arizona? Why aren't you doing the wind in the wind corridor in the middle of the country and then transmitting it over long distances where you lose 5-6%? But guess what? You've gotten 300, 400, 500% more energy output from the same solar panels, from the same wind turbines, having them out there. Who cares if you lose 5 or 6% transmitting it up to the Northeast? So we're just not approaching it in kind of the way that a coherent group of people would, but I don't know why we'd expect otherwise. Just finishing up on nuclear, there are new nuclear technologies which are much scarier, much safer, much less scary, I should say, much safer, and could bridge the gap, but it just has a horrible name, which maybe means it's a good investment.
So given the pressures on incredible population growth and on arable land, have you guys looked at opportunities for investing in fish farming? Because I know that the World Bank has highlighted that as an opportunity that needs capital.
Yeah, so fish farming is also part of kind of our universe and part of how we're investing in these themes. You have the heating up of the ocean, changing currents, acidification, all of these things changing the natural habitat for fish. You also have the fact that beef is incredibly methane intensive to produce, and not to mention all of the grains and everything else that go into it, so it puts a tremendous burden on our agricultural supplies as well. So fish farming is an interesting opportunity set, and we are looking at it and investing in it actively.
Okay.
One more question.
To your first point about, sorry, I hear myself and it's really unnerving. So to your first point about thinking disruptively about energy, one of the things that I've heard from renewable energy experts is about that 5, 6, or sometimes more % loss in the transfer of energy, and that we really think about renewable energy in the same way we've thought about traditional energy, and maybe that fundamentally is the flaw. And how is your firm thinking about things like vibro technology that, or solar film that a lot of really amazing academic institutions are creating right now that are more integrated energy technologies that will, power the building that the film is on, or power the lights of the bridge that the car goes over. Those kinds of really revolutionary technologies, but that are still so far from scale.
Yeah, so I have a little bit of a cop-out on that because we're focused on the public equity market, so by definition, we're really, someone from KKR should answer that. But we're really more focused on the mature technologies where there's a lot more kind of experience, like they've been around for longer periods of time. But certainly there's going to be a lot of disruption risk. Jeremy and his foundation invests in all sorts of kind of new efforts and kind of things along the lines of what you're talking about, although he's had a shaky history with the returns on some of them. So they're very risky. It's kind of a different part of the overall value chain or the overall solution. They're kind of the emerging new things. Most of them won't work out. Some of them will be huge hits. It's very hard to predict that ahead of time. So there's certainly a role for paying attention to it, and we do try to stay up to speed on all of those kinds of things, but it's very difficult to handicap. I will just finish up by saying that, I should have mentioned this earlier, but Jeremy kind of likes to characterize this as the race of our lives. On the one hand, you have all this technological disruption, you have all of these new technologies and emerging efforts out there, and technology's changing so much, and based on what you read from one week to another, you get very different stories, and it's actually kind of hard to understand just the rate of change and all these different efforts. We've talked about storage earlier as well. And on the other hand, obviously the climate and the environment is pretty unstable right now, and so he thinks this is kind of the biggest challenge facing humanity in an uncertain end.
On that small note, we'll, thanks.
Yes, great.